Welcome to our deep dive on small 401k rollovers and how to stop losing retirement money. Today, we will clarify common myths, show you the smart rollover strategy, and quantify the hidden cost of cashing out. We will then walk through step-by-step actions you can take today. Along the way, we will also test your knowledge with a couple of quick quizzes. Let's start by understanding why this topic matters so much, especially during job changes. Changing jobs is common and often leaves behind small 401k balances. These balances are easy to forget or dismiss as insignificant. However, even a small amount, like $1,000, can grow substantially over decades thanks to compounding. Therefore, treating these balances correctly can protect a meaningful portion of your future retirement security. Next, let's outline what we will cover today. Here is the agenda. First, we will bust the myth about minimum rollover amounts. Next, we will lay out the direct rollover strategy. Then, we will explain how to separate pre-tax and Roth components correctly. After that, we will quantify the real cost of cashing out due to lost compounding. Finally, we will finish with concrete action steps and a practical checklist. Before we jump in, a brief disclaimer. This content is for educational purposes only and does not constitute financial, tax, or legal advice. Your personal situation may differ. Before making any decisions, consult a qualified financial advisor or tax professional who can consider your specific circumstances. With that out of the way, let's move into myth busting. We often hear the claim that you need a minimum balance, sometimes $7,000, to roll over an old 401k. That is incorrect. There is no minimum rollover amount required to move funds into an IRA. The $7,000 figure is the annual contribution limit for new contributions to an IRA, which is unrelated to rollovers of existing savings. Consequently, even small balances, such as $1,000, should be preserved and rolled over so they can continue to compound for decades. Now that we have corrected the myth, let's shift to the optimal method of moving your money. The best practice is a direct rollover. In a direct rollover, the funds move from your old employer plan directly to your IRA custodian. This keeps the transaction tax-free and penalty-free. Critically, you should separate the money based on tax status. Pre-tax contributions, employer matches, and pre-tax gains go into a traditional IRA. Post-tax Roth contributions and Roth earnings go into a Roth IRA. If you instead choose an indirect rollover, where a distribution is sent to you and you have 60 days to redeposit, the plan will usually withhold taxes, and you risk missing the redeposit window, which can trigger taxes and penalties. Next, let's convert this strategy into concrete steps you can take today. First, open both a traditional IRA and a Roth IRA at a reputable, low-cost brokerage. Next, confirm with your former plan how much of your balance is pre-tax and how much is Roth. Then, request a direct rollover from the plan administrator to the appropriate IRAs. Provide your IRA account numbers and any required transfer details. After that, monitor the transfer to ensure the pre-tax portion arrives in the traditional IRA and the Roth portion arrives in the Roth IRA. Once the assets arrive, invest them promptly based on your risk tolerance and time horizon using low-cost diversified funds. Finally, document all confirmations and statements for your records. To further clarify the flow, let's visualize the interactions involved. This sequence diagram illustrates the communication flow. First, you contact the old plan administrator to request a direct rollover. The old plan administrator then sends the pre-tax funds directly to your new broker's traditional IRA and the Roth funds directly to your new broker's Roth IRA. The new broker confirms receipt to you. Finally, the Internal Revenue Service receives the appropriate informational forms, typically a 1099-R from the old plan and a 5498 from the new custodian, reflecting a non-taxable rollover when done correctly. The key takeaway is that pre-tax and Roth amounts should not be mixed. Now, let's quantify the cost of making the wrong choice and cashing out. When you cash out early, you may owe a 10% penalty plus ordinary income tax. However, the larger and often invisible cost is the lost compounding. For example, $1,000 invested at approximately 7% annual return for 30 years grows to about $7,612. Therefore, repeatedly cashing out small sums during job changes can significantly reduce your future, tax-advantaged retirement wealth. Next, let's compare tax and timing scenarios side by side. This table compares three scenarios. A direct rollover is not taxed, has no penalty, no withholding, and low administrative complexity. Again, an indirect rollover may be taxed and may incur penalties if you miss deadlines. It usually includes about 20% withholding and comes with high administrative complexity. A cash out before age 59.5 is typically taxed, likely carries a 10% penalty, involves withholding, and presents medium complexity. Given these trade-offs, direct rollover is generally the most efficient route. Now let's directly compare direct and indirect rollovers. In a direct rollover, the funds move directly from one custodian to another, avoiding taxes and penalties when executed properly. There is no 60-day redeposit pressure, and the reporting is straightforward, typically using Forms 1099-R and 5498. In contrast, an indirect rollover sends a check to you. You must redeposit the entire amount, including any withheld taxes, within 60 days. If you fail to do so, the distribution can be taxed and penalized. The indirect route also introduces a mandatory withholding hurdle of around 20%, making it less convenient and more risky. With the comparison clear, let's consolidate what to do in a concise, markdown checklist. Here is a concise checklist using markdown formatting. First, open a traditional IRA and a Roth IRA. Second, call your old plan and request a direct rollover. Third, ask for the balance split by pre-tax and Roth. Fourth, direct the pre-tax portion to your traditional IRA and the Roth portion to your Roth IRA. Fifth, confirm the transfers and invest promptly in low-cost diversified funds. Sixth, save all confirmations and statements. As a pro tip, label your accounts clearly in your brokerage interface to avoid mix-ups. Finally, remember that rollovers are not contributions, so the $7,000 annual contribution limit does not apply to rollovers. Next, let's highlight common pitfalls to avoid. These are frequent mistakes. First, cashing out because the amount seems small. Second, allowing an indirect rollover check to sit and missing the 60-day redeposit window. Third, mixing pre-tax and Roth funds, which can create avoidable tax consequences. Fourth, forgetting an old account completely, leaving the money uninvested or subject to fees. To cement your understanding, let's do a quick quiz. Quiz time. Question: is there a minimum balance required to roll over an old 401k to an IRA? Option A: yes, $7,000 minimum. Option B: yes, $1,000 minimum. Option C: no, there is no minimum. Option D: only if the plan allows it. You may pause the video now to think about the answer. Beneficiaries. We will discuss the answer in the next section of the video. The correct answer is no. There is no minimum. The $7,000 figure refers to the annual contribution limit for new IRA contributions, not to rollovers of existing funds. As a result, you should preserve every dollar. Next, another quick question about separating funds correctly. Second question: where should pre-tax and Roth 401k dollars go in a direct rollover? Option A: both to a traditional IRA. Option B: both to a Roth IRA. Option C: pre-tax to a traditional IRA and Roth to a Roth IRA. Option D: it does not matter. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is pre-tax flows to a traditional IRA and Roth flows to a Roth IRA. Mixing these sources can create taxable events, so keeping them separate maintains tax and penalty-free status. Now let's recap the key points. Here are the essential takeaways. There is no minimum balance to rollover. Use a direct rollover to avoid taxes and penalties. Separate pre-tax amounts to a traditional IRA and Roth amounts to a Roth IRA. Cashing out forfeits decades of compounding growth. Finally, open both IRAs, request the direct rollover, and invest promptly. To conclude, here is a quick wrap-up and your next step. In summary, confirm the split between pre-tax and Roth balances in your old plan. Open both a traditional IRA and a Roth IRA, then request a direct rollover to the appropriate accounts today. Automate your investing into low-cost diversified funds aligned with your goals, and keep thorough records. Finally, let's close with a quick thank you and a call to action. Thank you for watching. If this video helped you protect your retirement dollars, please like, share, and subscribe. Let us know in the comments about your rollover experiences, questions, or wins. Your engagement helps others find this critical information and protects more people from losing retirement money.